Hello, this is Bill Moreland with BankReg Data. Today I'm going to take a quick look at KeyBank. Key's worthy to look at for a number of reasons, but there's one in particular that caught my eye looking at the all-industry bank when the data came down last week. What I was doing is I basically went to the industry tab, I went to income and expense, and I looked at realized securities gains and losses. Because I was curious. We see a couple of quarters ago the industry took $9 billion, and a big chunk of that is Truist, $6.7 billion. But then you see the number was at 3 and 3.3. So banks are realizing a lot of losses. If I switch to the year-to-date, basically I can see the total year-to-date industry was $16.1 billion of losses against $12 billion last year and $4.7 billion the year before. So major losses, right? And so the first thing I did is I basically popped down here and I took a look at the detail, and then I sorted on that. And number one at $915 billion is KeyBank. So why is Key doing that, right? That is an enormous amount of money. And we see that it's consistent. A consistent 2 quarters, 900 million, 900 million. That's pushing $1 billion 2 quarters in a row. And if we come in, we can see that it is significantly impairing their ability to generate income. So the question is why? Why are they doing that, right? So I come back to securities and I go to look at appreciation, depreciation. And it wasn't that long ago, Key was technically bankrupt. I mean, you're looking at 45% of their tier 1 capital, $8 billion in losses against $17.4 billion in capital. But then you pop down here and you can basically see that they've lowered that number tremendously, right? We know that the industry mark-to-market losses were up significantly because the long bond was up, the 10-year was up, and so the aggregate industry losses. And we could see that coming back here by going back to the industry, going to securities, going to appreciation, depreciation. You can see the number climb from $364 billion to 482. So Key's numbers actually aren't too bad considering. But part of that is they've taken $2 billion worth of losses. So that number would technically be upwards of $6 billion, right? So we see that they're realizing those losses in a hard manner. And so the question begs, why? Why would they be doing that? And so the main reason, I believe, is they're being told to. And essentially how I think that's the case is if I come home to Bank Home and I go to Tier 1 Capital, remember this is going to be the depository, but I keep reading everywhere, banks are more capitalized this time around than they've ever been. And I'm skeptical of that. Yes, some certainly are more capitalized. But a lot of what appears to be going on is the illusion of capitalization. But let's take a quick look here at what's going on. So we see a couple of years ago, they had a 10 handle. A year and a half ago, 10. 10 is very low. Anything with a 10 on it is going to be considered low. And the reason is you can look at essentially this black chart and you can see they're very rarely down with a 10 handle. And when they do, it starts to go up, it goes down, and it gets a 10 and starts to go up. To show you how rare it is, you can come down here and look at all the other banks, all the other large banks, and you can see that 97% of them have an 11 or better. Only 3 are down at the bottom. And obviously those are worth discussing as well. So once they get to a 10 handle, typically I almost always see within a couple of quarters that number starts to work its way back up. So why was it low? Well, it was low because they were sitting at $160 billion of risk-weighted assets with $16.8 billion of capital, so 10.46. So as they were growing the bank, the capital started to go down. And you can see they were increasing the capital number, but essentially they were growing the assets or the risk-weighted assets as well faster. So what's happened since then? Well, the number basically peaks out here about $17.48 billion at 11.94. But really what they did is they shed 12 billion of risk-weighted assets, right? So 158.4, 146.4, 17.23, 17.48. But what that really did is by shrinking the denominator, in addition to increasing the numerator, it made that percentage grow more than it normally would. And so you can actually see they were in a weird situation where they were basically shrinking the bank every single quarter up until recently, up until Q4 right there. And what you did notice is they were actually burning capital. And then all of a sudden there was a big increase right there, 16.98 and 17.55. So what we're looking at here is this bank appears to be more capitalized than it's ever been. And so part of that is why? How are they getting there, right? And so you come in, you take a look at liabilities. Essentially, you come in and you say, well, what is? And so if I go to their call report, this is technically their call report right here. This is where the data is pulled from that we're sourcing. You see there's common stock and surplus of 11.146 billion, retained earnings of 8.8 billion, and then you see there's actually a reduction in AOCI, right? So what is AOCI? AOCI is the mark-to-market losses on their portfolio. And so the way this works, it's sort of deceptive, but let's just work through how it goes. Is you have securities data, you have appreciation, depreciation. That's essentially the mark-to-market losses. This is what we were looking at earlier, where it's up a little, but the reason it's not up full to $6 billion like it was for a number of quarters is because they liquidated $2 billion in taking those losses. But essentially, if we look at what the breakdown is, 3.58 is available for sale, and a much smaller 558 is in held to maturity. So to their credit, they don't have a lot of held to maturity. But what it means is available for sale does get marked to market every single quarter. But we don't see those losses. And the reason is because if you go to liabilities and you go to AOCI, these are actually the tax adjusted losses. So there's a little bit of gain from losing money. There's a tax benefit. But we can see that this number is still very, very significant. 5, almost $5 billion, and now it's back down. So there's the $2 billion, right? But if you look at this, that's how capital is, right? It's common stock and surplus plus retained earnings, less AOCI. And here's the tricky little thing. There's an AOCI opt-out. So it hits capital, it's removed from capital, and then we show what the capital number is right there at 16.8. But then you'll notice with that little tiny opt-out, the AOCI opt-out, they just add it right back in. So there is that negative 2.7 and negative 432, which is going to be the two different components that go into AOCI. So it does get added back, but at the top level, it's essentially removed. So we can see what the AOCI is. That is basically, at one level of observation, it's hurting capital. And so what they're doing is they raised capital, right? We saw this. If we come back in to Tier 1 capital, it jumped right there, 16.9 billion to 17.6 billion. So not only is that denominator shrinking quite a bit from 160 billion to 136, that's going to increase that denominator. That denominator going down is going to increase the ratio, even though they were basically starting to lose capital. But lo and behold, right there, 16.9 billion to 7.5. So they did a capital raise. Not only are they liquidating securities at a loss of $1 billion a quarter for 2 quarters, they actually did a capital raise. And when you come in and you look at it, you can see it. Any preferred? Nope. Common? Just that 50 million that's been there forever. There's your surplus. And essentially, there's your $650 million gain. So this is essentially going to be including capital contributions, right? So I don't know where they got the 700 billion from, but it clearly did a capital raise. So they're liquidating securities to take the losses, and they're actually increasing capital. My gut is they're being told to do this. They're being told that they have to essentially strengthen their capital position, and they're having to do multiple things to get them to that point. Why? Why are they being told to do these things? So you come back to Bank Home, and we see the growth, right? There's the growth of the bank, And then there's the bank shrinking the balance sheet, and part of that is to shrink the risk-weighted assets. We come down and we start to look at our tools. We got multifamily. We essentially, multifamily NPLs under the alerts. So we see a significantly large non-performing loan rate on their multifamily portfolio. And so if we come back to here, what else do we see? Well, our Sentry event engine is flagging a multifamily early stage problem, a multifamily charge-off problem. We also see CRE non-owner, non-performing, CRE non-owner charge-offs. And we see a very large amount, and that's what's here highlighted on the right in gold, of restructured debt. So, and probably to top it off is allowances down across the board in their commercial real estate portfolio, their residential portfolio, and their construction portfolio. So it's going to take a look at loans. All right, so the first thing we see is they're shrinking the bank. They are not growing their loan portfolio. So yes, we hear loans are getting better. The biggest banks are shrinking their loan book. And you can just see it across the board, bank after bank after bank. If we come down here and we look at delinquencies, we see the number was increasing. So if I'm the Fed and I'm worried about stress tests and I see a bank that's sitting on a lot of mark-to-market losses, that's technically bankrupt, and I don't know if we're going to be able to lower rates as much, I still think they are going to. I think the market will throw a fit and they'll drop rates. Everybody will run into the bonds for security, and that'll bring the long end down, and voila, a lot of these things get fixed. But if we take a look at this, increasing delinquency rates would be a concern. That would be a trigger from a liquidity concern. But we can see that the delinquency rate is climbing, but it's kind of started to come back down. But the restructured debt is continuing to climb. So let's come in and take a quick look at a couple of different things. We look at multifamily portfolio. That portfolio is shrinking dramatically. Remember, we saw some early stage delinquencies climbing quarter over quarter. So you see a wave of delinquencies climbing, and then the number goes down, and you see another wave building behind it. Some of it could be the same guys, some of it could be new guys. What's interesting is how much of this is sitting on 90 days past due, accruing fee and interest income. This is very rare, exceedingly rare. Like if I come down here and look at all the other banks that have $9 billion or $3 billion of multifamily, almost none of them have anything accruing fee and interest income. I mean, 92% of the banks have none. And the reason for that is they're supposed to be putting it on non-accrual. So there is a question as to why they're doing this. Typically when you see it, they're doing it across the board. I mean, there's a ton of loans that are sitting on 90 days past due. You see that in consumer because they have fast charge-off cycles. But C&I, multifamily, that's very unique. Typically only when there's government guarantees, but there's no guarantees on those two portfolios. So we come in and we see early stage, we see late stage for multifamily, and we see they just took a charge off, right? So that's what we saw a little bit earlier, is there are a number of portfolios that are having problems. There's the non-owner occupied NPLs. There's the early stage, not as much, but you see the wave building, goes down, non-performing, all right? Are they basically taking charge-offs? Yeah, they're taking some charge-offs. So we see credit issues building in a number of portfolios. There is one more that I wanted to take a look at down here that I saw, is this ag portfolio. We're starting to see an increase in ag and farmland, what I call ripples in the pond, where you're seeing delinquency starting to increase. In this particular instance, it clearly is one or two guys, 9.75 million, 10% of the book. They're shrinking that loan book, right? So we see, once again, we can see it climbing and then we see it shrinking. But that's a note or two that aren't making any payments. Are they in 90 days past due, accruing fee and interest income? Once again, why? I'm guessing it's on interest only. They're probably not making any principal payments. That's why it is what it is. That's why the dollar amount is identical. but they still want to recognize interest and fee income. So there's the question, right? Or there's the answer. Is that why they're doing that? Is they're putting a decent chunk of their loans on interest only? Let's come back. We looked at modifications. This is the one that's driving delinquencies. Delinquencies are doing this, and they started to come down. But what you're looking at here is you got to ignore this time frame right there. That's the old definition of TDR. It was redefined. There was a wipe clean of anybody who had been making payments. So really the new baseline is 93 million. And what you see here is it build and then go down and then skyrocket back up. And normally that would be problematic for me because why? Why is it doing that? Well, part and parcel to this happening where they redefined it and they wiped away collective memory was a FASB ruling. And I mentioned it multiple times, but I'm just going to keep, beating the drum. If the debtor makes 12 consecutive payments, the borrower, they get wiped away from TDR classification or loan mod classification. That's a no-no. They really shouldn't be doing that. I could see why FASB would be encouraged to do that from the banking lobby's perspective. But if you're a bank analyst or you're an outsider, or you're a counterparty risk, or you're an investor, you shouldn't be doing that. Because essentially, I did that at Wells. I drive a truck through these rules. So I call it the TDR Ferris wheel. You line up your troubled debt over here. You put them on the loan modification Ferris wheel. They work their way down. In the old world, the Ferris wheel only ever got bigger. But with this 2023 Q1 rule, you get somebody on the Ferris wheel, you lower their payment, they go 12 times around with payments, they get off the Ferris wheel. And so if you look at this, you can see that build, and then you see it go down. So the question is that the Ferris wheel? So whenever you see that pattern, you have to ask yourself, is that a reporting artifact? And one of the things that's happening is I know that there is some difference in the guidance that the Fed and the OCC is giving this in regards to what the FDIC is telling them. The FDIC says you can't get off the Ferris wheel. But the Fed and OCC, from my understanding, is there may be some instructions saying they can report FASB. But there also was some clarification that came through in 24 Q4. And what I'm wondering is if this is a fix. So instead of seeing that little dip, it really does build the whole time. But what we weren't seeing there was FASB rules. And then when it jumps back from 354 to 429 to 4, that's really the pattern. So net, what you're looking at here is an enormous amount of debt modifications. And a very large chunk of them are being left off non-accrual. So realistically, they're reporting 1.1 billion of delinquency, but there's another 400 million that is basically left off of non-accrual. What's interesting is look at the 22 million that's actually delinquent. It's been modified and no payments are being made and it dips back into delinquency, and yet they're still not putting it on non-accrual, which I don't understand how they're doing that, but you see it becoming more of a observation than what it typically should be. So realistically, what we're looking at here is if you look at total delinquencies plus performing modifications, the bank continues to have a significant amount of stress. It appears to be slowing a bit, but part of that is if you keep lowering payments on a long enough time frame and you do more and more and more, that should have a downward impact on delinquencies. The question is it solving the problem or is it just stretching that problem out? As long as we continue to see the combined numbers go up, the problem's still there. Last thing to look at is asset quality. Come in, I want to take a look at allowance. And so we can see that this bank is actually burning through allowance. It went from 1.56 billion, 1.50 billion to 1.4 billion. And if we come into income and expense, there's a reason for that. They had to take losses, right? So this is what I'm looking at is right here. So interest income is 2.158 billion in Q3, 2.11 billion in Q4. So they lost $45 million of interest income. Part of that, I'm going to guess, is from the loan portfolio. And so you do see a drop in the loan yield. And you see it drop from 577 to 559. Those are going to be adjustable rates. You come into balances due, that's where the big one is. That's the Fed. This is the money sitting at the Fed's IORB, 241 million to 210 million, right? So, and it's almost the exact same denominator, 17.8, 17.5. There's the Fed at 5.4%. There's the Fed where it is now. So really what you have going on here, come back to income and expenses, they lost $45 million when the Fed started lowering rates. But the reason the Fed lowers the rates is because they picked up $136 million by dropping it on their CDs, calling in broker deposits if they had any that they wanted to basically shorten up and call. So there's a kitty there, right? There's a $90 million kitty that there's what I call an interest rate differential. But you see they also picked up $55 million by lowering provision. So allowance is going down. Provision fills the allowance bucket. But we see they went from 94 million to 39 million. So now we see they picked up another $55 million. And really what that allowed them to do is 90 million in differential there, plus 54 million there is about 130 million, 140 million. Lo and behold, that's how they booked more income in the quarter. So even though they're burning $950 million, 934 million quarter in, quarter out for 2 quarters to get there, right? They're trying to improve their perceived capital position. Really, it was a sleight of hand. How they really only generated pre-tax net operating income less than what it was before is grandma subsidized it and they didn't put any in provision. So you come into provision and you can actually see their 39 million is as low as it's been in almost 3 years. An incredibly low number. So low that if you come down here, you see that they're in the 31st percentile, right? So they're not bad. At least they're not taking provision draws. There's a number of banks that are taking money out of provision. They're not that far. But realistically, what that means is, go back here, take a look at net charge-offs. They're still booking charge-offs. Those charge-off numbers are still going up. Granted, they're down a little bit. And so maybe that's how they justified that 54 million drop in provision right there is because net charge-offs fell. But that's still, they took more out of provision than they really could have maybe justified. And the reason for that is they're basically trying to show some income improvement. But it's subsidized from grandma and it's basically taking out. The net on that is we come back here and take a look at allowance. Their allowance is shrinking. So their 135 is down from, it's not horrible, but it's down from where they've been historically last couple of quarters. And realistically, they're in the 34th percentile there. You take a look at UBPR1. This is going to be the big guys. They're an 18 out of 28. I'm going to pop back here. What I like to look at is the coverage ratio. This tells you how many dollars of reserves they have for every dollar of adjusted NPLs. And they're sitting at $1.67, which is the lowest they've been in a long, long time. If we take into consideration their performing TDR, where they just keep restructuring and restructuring and restructuring, we can see that $1.14. We have to go back a number of years. And realistically, if you look at the black chart, the difference between the left-hand side of this is when they were lower, is that was an expanding an economy time frame where delinquencies were going down. There wasn't any performing TDR during this time frame. So running really low coverage ratios was a lot more justifiable because the asset quality metrics were all spectacularly good. What I've showed you today is they're having a lot of non-performing loan issues, they're having a lot of modification issues, and realistically, they're becoming less and less reserved. As always, I appreciate your time. If you have any questions, please feel free to reach out.